Last time I met you at Tirupati.
Yes, sir.
Devaraya Reddy conducted some program.
Yes, sir. Yes, sir. Yes, sir.
Yes,
How are
sir.
you, sir?
Fine, fine, sir. Thank you very much, sir.
Welcome, sir.
Sir, can we have some session on this e-assessment?
You'll have to give me time, sir. I have to read.
No problem, sir. because once this is started, lot of litigation will start.
I'm hoping, sir.
It is what do you call, lot of work for us.
No. See, there was one old newspaper clipping that I was reading when I was in reading the paper long back.
Sir.
Monsoon in Kerala delayed, doctors unhappy. Because when monsoon starts, diseases start.
Of course.
When diseases start, doctors are happy. It is like that. So if there is a problem, litigants like people.
That is what, sir.
You are going to get more work.
Actually, there is a saying also, no, sir. Doctors pray to the God that they should get more patients. Lawyers pray to the God that they should get more litigation. What do you call, criminal and civil cases? We, the chartered accountants, we pray God that our client should flourish, so that we also will flourish.
But lawyers should pray that there are more criminals, isn't it, sir?
Yes, sir.
Sir, I'll just break for about 5 minutes and I will join again, sir.
Oh, okay, sir. Okay, sir. Thank you very much, sir. Thank you, sir. We will be online, sir. Nilesh bhai? Ravi?
Yes, sir. Nilesh bhai has not joined yet.
Nilesh sir, chairman साहब अभी नहीं ज्वाइन हुआ?
नहीं हुआ सर.
हाँ. आप ऑफिस में, आप घर में है?
हाँ सर, मैं घर में हूँ. वर्क फ्रॉम होम.
हाँ. वही बच्ची का आवाज आ रहा है.
वो घर का बैकग्राउंड म्यूजिक है सर.
नहीं भाई, घर का बैकग्राउंड म्यूजिक नहीं बोलना. अपना मोटिवेशनल म्यूजिक बोलना. कितने लोग है? 2 है, 1 है? एक
ही है सर अभी तो फिलहाल. वो एक ही भारी पड़ रहा है.
क्यों? और एक को लेके आए तो भारी नहीं पड़ता. दोनों से क्या बोलते, बैलेंस हो जाते.
क्या हुआ? बंद कर लिया? हाँ माँ, चले यहाँ पे.
ఎవరినైనా వాళ్ళు మనీ 1.5 పంపించారు. రేట్ వచ్చింది. నువ్వు అన్ని రెడీ చేస్తే రేపు చూద్దాం. ఇప్పుడు మీటింగ్ స్టార్ట్ అయినప్పుడు నువ్వు సామూర్తి గారు నమస్కారం. మహేష్ అని అచ్చా అక్కడికి వెళ్ళాడు. ఇక బుక్ తీయించేసేయండి. కొంచెం నాకు మంచిది తెచ్చి పెట్టండి.
రామూర్తి గారు
నమస్కారం సార్.
మాటలు వినిపించట్లే, మీ శబ్దం రావట్లే.
లేదు అట్లా కాదు, నేను సామూర్తి గారు అన్నాను, మీరేం మాట్లాడకపోయారు.
మూగబోయింది.
నేనా?
స్పీకర్ సౌండ్ పెంచండి.
నా స్పీకరా?
వినిపించట్లే మాకు.
అవునా? అయ్యా ఇప్పుడు సార్
సార్ నేను చెప్తాను, మీరు వినండి. మీ ముందర లైట్ వేయండి, ఎందుకంటే మీ వెనకాల లైట్ గ్లేర్ ఎక్కువ ఉంది. మీ ముందర లైట్ వేయండి.
నాకు ముందర లైట్ ఏం లేదు,
ఏం వినిపించట్లే. మీరు సైగలు చేయాల్సిందే.
అవునా?
మీరు ఓన్లీ మాకు చిన్నప్పుడు దూరదర్శన్ లో 115కి వార్తలు వచ్చేవి, అట్లా చూపించాల్సిందే.
అట్లా కాదు, నాకు అది డౌట్ వచ్చి నేను ఫస్టే మన రవి తోటి మాట్లాడాను. రవికి
రావట్లే, సౌండ్ రావట్లే.
రవికి వినిపిస్తుంది అన్నాడు.
మీరు సెట్టింగ్స్ సరిగా చేయలే, సెట్టింగ్స్ చేయలే. స్పీకర్ మీద స్పీకర్ మీద వచ్చేసేసి
రవి
మైక్రోఫోన్ మీద క్లిక్ చేయండి. ప్రాబ్లీ ఇట్ ఈస్ కనెక్టెడ్ టు సమ్ అదర్ థింగ్. మీరు ఎట్లా మొబైలా ల్యాప్టాపా?
ల్యాప్టాప్ అట్లా కదా. ఒక్క నిమిషం
మీరు
రవి భాయ్,
మీరు సైగా చేయండి, తెలియట్లేదు. మొబైల్ అయితే చెవు దగ్గర పెట్టండి, ల్యాప్టాప్ అయితే ఇట్లా ఒక రెక్టాంగిల్ గీసి చూపియండి. మీరు చెవు దగ్గర చేయి పెడితే మొబైల్, ఏది రెక్టాంగిల్ అంటే మీ డెస్క్టాప్ అన్నమాట. అయితే రైట్ సైడ్ వెళ్ళండి, వెళ్తే కింద స్పీకర్ అని కనిపిస్తుంది, ఒక సౌండ్ లాగా ఒక పుంగి.
ఫుల్ ఉంది సార్. అది
రైట్ మౌస్ క్లిక్ చేసి చేయండి, అది స్పీకర్ సెట్టింగ్స్ లో ఉంది.
रवि भाई
जी सर।
राममूर्ति सर साइलेंट मोड में आए नीलेश. He is only video, no audio.
नहीं, Ravi is able to hear me. And I had a talk with Banusekar sir also. Nilesh bhai, good morning, good evening, good afternoon.
बना के दे दो, छोड़ो ना, उससे पूछो मत।
Nilesh bhai,
Good evening, boss.
are you able to hear me?
Yes, I can hear you.
But Samamurthy is complaining.
సౌండ్ రావట్లేదు రామ్మూర్తి గారు.
అందరికి వినిపిస్తుంది బస్, మీకే వినిపించలేదు అంటున్నారు.
Sambamurthy sir, can you hear me?
Nilesh,
Sambamurthy sir, can you hear me?
आज होस्ट कौन है? रवि
सर का स्पीकर में कुछ प्रॉब्लम है, मैं उनसे बात करता हूँ 1 मिनट।
आपसे एक बार बात करो भाई। 4:30 हो गया, शुरू करना। साहब, चेयरमैन साहब।
Good evening, Mr. Banusekar.
No, Banusekar sir is already there. He said within 1 minute he will join back.
No, he's there. I was just wishing him. Good evening, sir.
Good evening, sir.
Good evening, sir. Banu sir, good evening.
Good evening, sir. Good evening.
नीलेश भाई, राधिका जी, गुड मॉर्निंग, गुड इवनिंग, गुड आफ्टरनून. Radhika garu, good afternoon.
Good afternoon, Ramurthy garu. Good afternoon, sir.
Namaskaram. Nilesh bhai. Nilesh bhai. Nilesh bhai. Start start करो भाई.
12 members. I will just wait for 5 minutes.
18 members आए सो है. साहब को वेट कराना ठीक नहीं है ना. So sir को एक बार बोल दीजिए ना. He will be on.
Sir, we will start exactly at 4:38. No, in 5 minutes exactly.
Sure.
At 4:36 we will start the introduction, and 4:38 we will start the program.
Fine.
Right.
Anu sir.
Yes.
Anu sir, I am Sambamurthy from Hyderabad. Just I wanted to share a small thing before we commence. This is Hyderabad now, sir. Here we tell Nawab gaye, Nawabgiri nahi gaye. That means the rulers have gone, but the ruling powers or mentality has not gone. So when you tell it is 4:30, they will have the habit of coming at 4:35, 4:40, 4:45. Leisurely they will be coming.
Fair enough, no, sir. Because see, one thing is, if there is no audience, see, I went to one Rotary Club long back, some 15, 20 years back, and they invited me to speak. And I asked them, how long can I speak? They said, you can speak for any length of time. We will quit after 30 minutes.
That's a good one.
We will not stop you from speaking at all. We will all leave after 30 minutes or 40 minutes or what. So they are the kings, sir. See, actually, we may be the king, but they are the king makers. In Mahabharata also, Krishna is the king maker. He is not the king at all. But he is the most crucial role. So we'll wait, sir. Not a problem at all.
That's all.
Not a problem at all. This is on behalf of the Chamber of Tax Consultants, Hyderabad Study Circle, is it, sir?
Yes, sir.
Yes.
Chamber of Tax Consultants. We formed this study circle just 1.5 years. Last year, February, sir.
Okay.
So from then onwards, initially we started GST discussions, then slowly transformed to FEMA, and along with that budgets, and then now direct taxation. And likewise, we are trying to extend our tentacles to all the areas of our practice subjects. So we are our captain is Nilesh Vitlani.
Okay.
So
5:30
Sir, let us start now, Nilesh sir.
yes,
It's
sir.
4:36 now.
So, good evening, everyone. Welcome you to this study circle meeting on penalties under the Income Tax Act. And we have none other than Mr. T. Banusekar from Chennai addressing us on this topic. And Mr. Ramurthy has been the coordinator for the income tax part of the study group. So, thank you, Mr. Ramurthy, for all the organizing and getting Mr. Banusekar to this forum. Over to Mr. Ramurthy.
Thank you, Nilesh. In fact, it is my pleasure to take the duty of discharging this function. First of all, I thank Banusekar sir for accepting our invitation, because over a WhatsApp I contacted sir. Immediately he said which day you want and what is the timing and other things. So sir has given us free hand to decide the date and timing and other things. Thank you very much, sir. And before handing over the proceedings to Banusekar sir, as a formal procedure, I give introduction because Banusekar sir is guru to many CA students. They might have heard him n number of times. And I was one of the student when he has addressed one of the student forums. Okay. So, Sri Tyagarajan Banusekar, fellow member of the institute, is a partner in CRBS and Associates Chartered Accountants, Chennai since 1994. He has contributed articles on direct taxes and international taxation to several tax journals, including Consolidated Commercial Digest, published by the publishers of Income Tax Reports, Taxman, Tax Referencer, and the Income Tax Review, published by the Chamber of Income Tax Consultants, Mumbai. He has argued in number of cases. The orders passed are landmark in their nature, and these orders are passed by various benches of income tax appellate tribunals across the country, which have resulted in establishing precedents for many common contemporary issues subsequent to the orders. Few among them: Ford India Limited relating to claim of deduction for warranty expenses, Scapsoft Limited before the special bench on the parity between numerator and denominator in computing deductions under Section 10A, Ford Business Services Center Private Limited relating to the benefits under Section 10A, SSI Limited relating to taxation of ESOPs, Vijaya Productions relating to the accrual of capital gains, Apollo Hospitals Enterprises Limited relating to taxability of capital gains earned in India on sale of shares in Sri Lankan company, Estman Exports Global Clothing Private Limited relating to taxability of exports incentives in the form of MLFPS scripts, Filtrex Technologies Limited relating to disallowance under Section 40AI, Pretex Limited relating to application of provisions of Section 163, South India Corporation Limited relating to disallowance of interest paid on borrowed funds on account of interest-free advances to group concerns, AVM Charities relating to claim of exemptions under Section 11, Hillcraft Pharma India Private Limited relating to the allowability of sales promotion expenditure in the form of freebies and gifts incurred by the pharmaceutical industry in the light of CBDT Circular Number 5/2012, and Synergy Maritime India Limited relating to transfer pricing issues. When we see, these are the issues specific in nature. So, sir has given way to so many of us how to deal with these things. Having argued number of cases in various benches of the Income Tax Settlement Commission, he has authored following books: Handbook on Assessment Procedures under the Income Tax Act 1961, Search Assessment under Income Tax Act. Formerly a visiting faculty to the Institute of Chartered Accountants of India, Institute of Company Secretaries of India, and the Loyola Institute of Business Administration and Direct Taxes. Delivered lectures and presented papers on direct taxes and international taxation at seminars, meetings, workshops, and conferences organized by ICAI, SIRC of ICAI, as well as other regions of the ICAI, apart from those organized by other professionals and public bodies, including several branches of various regions of the Institute of Chartered Accountants of India. Actively participated as a trustee in brain trust sessions organized by the branches of the ICAI. Participated in training programs for commissioners of income tax conducted by the regional training institutes of the Income Tax Department and also the Central Training Institute, that is National Academy of Direct Taxes. He has been the chairman of Direct Tax Committee of the Hindustan Chamber of Commerce, formerly a columnist in the Hindu business line in the personal finance page, featured on Sundays, authoring the column Tax Talk. a former member of the Southern India Regional Council of the Institute of Chartered Accountants of India for the period 2001 to 2004. Past chairman of Fiscal Laws Committee of Southern India Regional Council of the ICAI. Special invitee in the Direct Access Committee of ICAI and in the Continuing Professional Education Committee of ICAI. Presently co-opted member of Direct Access and International Tax Committee of SIRC of ICAI. Leaving all these things aside, sir, as a professionalist and as an academician, is very keen to guide the next generations and the future generations. This is the just example of his acceptance of our invitation. With this brief profile, I request sir to take the session.
Thank you, Mr. Ramamurthy. First thing is, I think I will make 2 points very clear. One is this entire biodata was given by me and therefore has to only speak kind words about me. So I will anyway thank Mr. Ramamurthy for the kind words. And to quickly endear myself to the audience, one of the other cases that I argued in the Hyderabad bench was also that of Mahesh Babu.
Oh, it is not there, sir.
Not there in the list. That can probably endear me closer to people of Telangana.
Yes, sir. Yes, sir.
Hyderabad. Well, friends, we are here to share our thoughts on a very important subject of penalties, because there are a number of penalties that are starting to become applicable, which were not applicable earlier. In fact, I will primarily deal with section 270A, 270AA being the new substitute for 271(1)(c). I will also be dealing with 271AAB and AAC because it will become inevitable as we are discussing about 270 capital A. And we will also deal with the newly inserted 271AAD, which is the penalty that is introduced by the Finance Act 2020. Well, friends, I'm sure all of us are quite thorough with the provisions relating to 271(1)(c), which deals with penalty for concealment or furnishing of inaccurate particulars of income. Concealment or furnishing of inaccurate particulars of income. Now, basically, the provisions of 271(1)(c) contemplated one out of two things, either a concealment or a furnishing of inaccurate particulars of income. Not to say that there cannot be both concealment and the furnishing of inaccurate. Well, be that as it may, the law relating to 271(1)(c) concealment or furnishing of inaccurate particulars of income has evolved over several decades. And I think there has been quite a bit of, judge-made law on the subject, and quite a bit of clarity has been lent. In fact, we have some very landmark decisions in the nature of various aspects dealing with 271(1)(c). We have the decisional Supreme Court in MacData as to whether one can say that if one voluntarily offers an income, it can be said to be not falling within the ambit of 271(1)(c). You have the decision in Price Waterhouse where the Supreme Court held that an inadvertent error cannot lead to a penalty. Or you have various decisions starting from Reliance Petrochemicals to Dharmendra Textiles to so many other cases where the issue relating to penalty has been discussed in depth in the context of 271(1)(c). While that is said, all of us are aware that there are explanations below 271(1)(c), which I will quickly run through. I am aware of the fact that 271(1)(c) is not applicable with effect from assessment year 17-18, and that 270A is alone applicable with effect from assessment year 17-18. But in any case, to understand the gamut of 270A, I will quickly deal with the various explanations below 271(1)(c). 271(1)(c) has effectively 7 explanations below it. The first explanation being which provides that where the assessee fails to offer an explanation or offers an explanation which is found to be false, or offers an explanation which he is not able to substantiate and fails to prove that such explanation is bona fide. Now, this is a very interesting explanation, which provides you fail to offer an explanation, then penalty under 271(1)(c) is exigible. You offer an explanation, but it is found to be false. So this is a positive act where the assessing officer has to come to the conclusion that the explanation is false. So he has to positively come to that conclusion, in which case also the penalty can be exigible. And 3, it says, offers an explanation which he is not able to substantiate. Now, obviously, if I am not able to substantiate, that by itself does not lead to the penalty, because it says, and fails to prove that the explanation is not bona fide. So if you are able to substantiate the explanation, no penalty is exigible. At the same time, if you are not able to substantiate, but if you are able to demonstrate that the explanation is bona fide, then also penalty is not exigible under the Act. This is so far as the first explanation is concerned. Now, the second explanation is a very complicatedly worded explanation. It virtually doesn't contain a full stop from the beginning to the end. But the long and short of that explanation is that if there is a deemed addition, an addition which is made under 68 or 69, etc., and if at a later point in a subsequent year, the assessee claims credit for the same, having not claimed credit in the year in which the addition was made, if he claims credit in a subsequent year, then in that subsequent year, he is deemed to have concealed income. In other words, there is a credit in my books of account, say, relating to the assessment year 2014-15. The previous year, 13-14. The assessing officer makes an addition. However, for reasons best known, he does not levy the penalty under 271(1)(c). This is in the previous year 13-14, assessment year 14-15. Now, in the previous year 15-16, assessment year 16-17, assuming the assessee takes credit for this amount by crediting his capital account from the credit which is otherwise available, and tries to take this as a source for any other investment or expenditure, etc., then in that year, he will be deemed to have concealed income. That is, in the assessment year 16-17, he will be deemed to have concealed income and penalty will become exigible under 271(1)(c). This is the scope of explanation 2. Explanation 3 deals with a situation where the assessee fails to file a return within the time allowed in 153(1), that is the time for framing an assessment, and where no notice under 142(1) or 148 has been issued. Even if he files the return after the issuance of a 148 notice, the penalty can be exigible. This explanation is there because where an assessee does not file a return, you cannot say that he concealed income because there is nothing in the return which is there, because no return at all is filed. This can be an excuse to the assessee, and therefore this explanation. Explanation 4 is to take care of a situation where a loss is converted into income or where a loss is reduced in assessment. And in such case, the amount of addition that is made itself will be deemed to be the concealed income and penalty can be levied. Explanation 5 is no longer relevant because it deals with searches before 1/6/2007. Searches before 1/6/2007. Now explanation 5A takes over, and in respect of searches on or after 1/6/2007, other than for specified years, the penalty is leviable in terms of explanation 5A, where the additions will result in there being a presumption of concealment. Of course, for specified years, that is the year of search and the year immediately preceding the previous year of search, where the due date for filing return under 139(1) has not expired and where no return is filed, the provisions of explanation 5 will not apply, but the provisions of 271 AAB will apply. Earlier it was 271 AAA, later on it became 271 AAB. Those would apply. Explanation 6 talked of no penalty for adjustments made under 143(1), and explanation 7 provided that where there is a transfer pricing adjustment, the amount of transfer pricing adjustment will be deemed to be a concealed income. This is how the provisions of 271(1)(c) were insofar as penalty is concerned. as it stood up to assessment year 16-17. Now, if you look at the starting of 270 capital A, 270 capital A is on a completely different footing from 271 1C. One has to be extremely careful and wary about the provisions of 270A because they are on completely different footing from 271 1C. I will start with the language used in 271 1C. It starts off with saying the assessing officer, the commissioner appeal, the principal commissioner or the commissioner, as in the course of proceedings under the Act, is satisfied. So, if the assessing officer, the principal commissioner, the commissioner or the commissioner appeal is satisfied in the course of proceedings that any person has concealed particulars of income or furnished inaccurate particulars of income. So, there is a requirement that there must be a subjective satisfaction. A subjective satisfaction that is reached by the concerned authority, namely the assessing officer, the commissioner of income tax appeals, the principal commissioner of income tax, or the commissioner of income tax. Now we can imagine different situations. Normally an assessing officer in the course of assessment, a commissioner appeal in the course of appellate proceedings where he is seeking to enhance, or a commissioner or a principal commissioner in the course of 263 proceedings where there is going to be an enhancement of income. In such circumstances, the concerned authority should in the course of proceedings be satisfied. Now questions have been raised as to what should be the recording of satisfaction. I think that is answered in 271(1)(b) itself, capital B itself. It says that the mere reference to the initiation of penalty is enough for a satisfaction to be said to have been reached in the course of proceedings. So once we say that, the next question is with regard to the penalty, where it could be 100% to 300% of the income sought to be evaded, either by concealment or by furnishing of inaccurate particulars of income. Now, having said this, if you look at this in contradistinction to the provisions or the language in 270 capital A, 270 capital A says the assessing officer or the commissioner of income tax appeals or the principal commissioner or the commissioner may, during the course of proceedings, up to this it is the same under this Act, up to this it is the same like 271 1C. Then it proceeds to say, direct that any person who has underreported his income shall waive a way of penalty in addition to tax. So they are now talking about not a satisfaction but a direction. I will deal with this as I proceed further. But then friends, you will remember for the time being that we are here referring to a slightly different language compared to 271 1C. 271 1C deals with recording a satisfaction and 270A talks of directing that a person who has underreported shall be liable to pay a penalty. So this also you will remember friends should arise in the course of proceedings only. As I said, 270A is applicable from assessment year 17-18. And the first aspect that we need to remember before we proceed is that 270 capital A divides penalty cases into two different kinds. One is assessees who have underreported income, and two are assessees who have underreported income as a result of misreporting. So underreporting is one language used. Underreporting as a result of misreporting is a second language used. For the sake of convenience, friends, what I will do is, I will not every time probably refer to underreporting as a result of misreporting. I will refer to these as underreporting and misreporting. But then, friends, language is very, very important here because if you see the opening clauses of 270 capital A, nowhere there is a reference to misreporting. In fact, misreporting is only referred to for the first time in 270 capital A subsection 8. Up to that point in time, the law does not talk of misreporting. Please remember, misreporting is only a part of underreporting. I'll put it this way. Every underreporting is not a misreporting, but every misreporting is definitely also an underreporting. Every misreporting is also an underreporting. Right? Now, having said this, you will have to look at various aspects in the context of 270 capital A. But before we get there, I will go to subsection 2 of section 270A, which deals with underreporting of income and provides for 7 different circumstances in which a person is said to have underreported his income. It talks of 7 different circumstances in which the person is said to have underreported income. A, the first one, where the income assessed is higher than the income determined in the intimation under 143(1). Now you will see that explanation 6 to section 271(1)(c) clearly provides that a 143(1) adjustment, if any made, will not result in the levy of penalty under 271(1)(c). Now, instead of providing for something like that here, what they apparently seem to have done in clause A is to say that if the income assessed is more than what is determined under 143(1), so automatically income that is determined under 143(1) is not underreporting of income at all, even if there is an adjustment, because it is basically some kind of a prima facie adjustment. And that cannot be as a result of underreporting, is what the lawmaker opines. So where there is an income that is determined in a 143(3) or a 144 or whatever, and there is already an income returned. Supposing the income returned is 10 lakh, income determined under 143(1) is 15 lakh, and the income assessed is 23 lakh. The penalty will lie on 8 lakh. That is the difference between 23 lakh and 15 lakh is probably what clause A is suggesting. Clause B, where no return of income is filed and where the return is filed for the first time under 148 and the income assessed is higher than the maximum amount not chargeable to tax. Right? Now, this is a situation where I have not filed a return or filed for the first time in response to a 148. Notice then the income assessed, if it is more than the income that is exceeding or more than the maximum amount not chargeable to tax, then there is an underreporting. 3, where the income reassessed is higher than the income already assessed or reassessed. Now here we are presuming a situation where there has already been an assessment framed either under 143(3) or 144 or under 147 or whatever may be the problem. And there is going to be one more reassessment, and on that reassessment a higher income is assessed. On that higher income the penalty will be levied. That is, if my 143(3) in the earlier example, which was determined at 23 lakhs, is now redetermined at 26 lakhs, then the 2 lakhs is the income that is underreported by virtue of clause C. Clause D. Now, these 3 deal with actual incomes. Clause D to F deal with deemed income. Clause D, where the deemed total income assessed or reassessed under the MAT or AMT provisions, that is 115 JB or JC provisions, is higher than the deemed total income determined in the intimation under 143(1). This is similar to your clause A, but where a deemed income is determined and not a regular income determined in terms of the regular provisions of the Act. Clause E deals with a situation where no return is filed or where a return of income is filed for the first time under 148 and a deemed income is determined under 115 JB or JC, that is MAT or AMT provisions, is higher than the maximum amount not chargeable to tax. Again, this is very similar to your clause B that we discussed a little earlier. Clause F, where the deemed total income reassessed under the MAT or AMT provisions is higher than the income already assessed or reassessed. Is higher than the income already assessed or reassessed. This again is very similar to your clause C. I'll come back to deal with each one of these, but then for the time being. And clause G says, where the assessed or reassessed income reduces the loss claimed or where the loss declared is converted into income. You returned a loss, the loss is reduced, or the loss is converted into income, you are said to have underreported income. Now you will see that clause A to C deal with the computation of income under the regular provisions or the normal provisions of the Income Tax Act. Clauses D to F deal with MAT and AMT, and clause G deals with the situation where a loss is converted into income or a loss is reduced in. So these are the various circumstances that result in underreporting of income. Now 270A, you will notice, is different from the provisions of 271(1)(c). In that, if you see plain and simple, 271(1)(c) deals with a situation where an assessee has concealed or furnished inaccurate particulars of income. Subsection 2 of 270A does not deal with either concealment or furnishing of inaccurate particulars of income. It only talks of a situation where, compared to your returned income or compared to a case where no income is returned at all because of non-filing of a return, if any additions are made and your income is increased or your loss is reduced, then there is a underreporting. This is what subsection 2 talks of. So I will hereafter refer to 270A as what I have coined as a terminology, a variance penalty. The minute there is a variance in your income, a variance in your loss, the penalty gets triggered. It is said to have, you are said to have underreported income. You are said to have underreported income. Now, a couple of aspects before we proceed further to subsection 3. I will then try to give an overall picture of how it works. First thing is, if you see, the lawmaker seems to have been a little overzealous, and there are several circumstances or situations which I can point out where the lawmaker seems to have been in a haste in drafting these provisions, if I am permitted to use that language. Now, why do I say the lawmaker has been overzealous? You see, for example, the provisions of 270A subsection 2 in clause E. It says the amount of deemed total income assessed as per the provisions of 115 JB or JC is greater than the maximum amount not chargeable to tax where no return has been filed. This is the language. No return is filed and 115 JB or JC income is determined. Now, 115 JC, for example, when it is invocable when the assessee claims certain deductions like 10A or the benefit of chapter 6A relating to incomes in his return of income. Only then 115 JC is invocable. If I do not file a return of income, then I would not have claimed any deductions at all. If I have not claimed any deductions, where is the question of invoking 115 JC? However, the lawmaker seems to have contemplated even a situation where there is a deemed total income which will be determined under 115 JC, even where there is no return filed by the assessee at all. This looks to be an impossible situation, but all the same, the lawmaker seems to have made a provision for that also. That is why I said they have been overzealous. Next, if you look at clause F, it talks of the income assessed or reassessed has the effect of reducing the loss or converting a loss into income. Now let me take a situation like this. My business income in the current year is 15 lakh, let us say. My brought forward business loss is 25 lakhs. So I set off the 25 lakhs and return an income of nil. 143.1 is also determined at the same figure without making any adjustment. So my 143.1 is also nil. Next, 143.3 is framed on me, at which time they find that my business income is not 15 lakh, but my business income is say 22 lakhs. For 7 lakh addition is to be made. Now, what will be the income that is to be determined? The income that is to be determined will be 22 lakhs as reduced by the brought forward loss to the extent of 22 lakhs, which is nil. Balance, that is my earlier I had said that my further loss can be carried forward to the extent of 10 lakhs. Now that 10 lakhs is going to become 3 lakhs. That is all. My income of the current year is not varied. So there seems to be no mechanism in 270A subsection 2 to say that there is a case of underreporting at all in such a circumstance. This seems to be again a fallacy that can be found in the provisions relating to 270 capital A subsection 2. Now going on to subsection 3. Subsection 3 deals with circumstances where the underreporting, what is the amount of underreported income? 270A talks about circumstances which are resulting in underreporting. Subsection 3 deals with what is the quantum of income that is said to have been underreported. So there is a mechanism to determine the income underreported and the tax on the income underreported also. So we are now talking about the income that is said to have been underreported. So in subsection 3 it says, in case where a return is, where income is assessed for the first time, if a return of income has been furnished, the difference between the amount assessed and the amount determined under 143.1. And if no return is furnished, the amount of income assessed, we will say as increased by the maximum amount not chargeable to tax. In the case of a company or a firm, etc., the maximum amount not chargeable to tax would be nil, and therefore the entire income assessed will be taken. The difference between the income assessed and the maximum amount not chargeable to tax. So if say I am an individual and my basic exemption limit is say 2.5 lakh, then if my income assessed is 10 lakh, the amount of escaped income or underreported income will be 7.5 lakh. If I am a company, then the entire 10 lakh will become my underreported income. And in any other case, it goes on to say, in any other case, the difference between the income assessed and or recomputed and the amount of income assessed or recomputed in the preceding order. So we are now looking at a situation where the income is assessed for first time, A, and you have filed a return and 143.1 has been done. Then the difference between the income assessed and the 143.1 income. So that the 143.1 income is not going to suffer any penalty. Next, if you have not filed a return of income, the entire income assessed, and if you are an individual, etc., where you have a maximum amount not chargeable to tax, reduce the maximum amount not chargeable to tax. I've explained that also. And thirdly, a case where that does not fall under what we discussed earlier, then the amount of income that is assessed or reassessed in the present proceeding subtracted by what has already been determined. In earlier proceedings. Because in earlier proceedings, whatever has been determined, that income would have suffered a penalty there itself. That is the logic. So this is so far as subsection 3 is concerned. Now in subsection 3 itself, what happens when there is a reduction of losses or conversion of loss into income? Now, if you see clause G of subsection 2 of 270 capital A, it says the income assessed or reassessed has the effect of reducing the loss or converting such loss into income. Now, we will have to understand also that reference to income will include losses also. So let us assume a situation like what is provided for in 270A3 clause 1. Right? Now it provides that the underreported income shall be the difference between the amount of income assessed and the amount of income determined under 143.1. So 143.1 will not suffer to the extent of 143.1 adjustment, penalty will not be levied. Now let us take a slightly different example. Your loss returned is 20 lakhs. Your loss returned is 20 lakhs. Your loss determined under 143.1, let us say, is 10 lakhs. At that stage, no penalty would be levied. And in 143 proceedings, your income is determined at plus 10 lakh. In 143.1 proceedings, it was minus 10 lakh. In 143.3 proceedings, it becomes plus 10 lakh. Now, on what should penalty be levied? Now, you have filed a return of income. You have filed a return of income, and your returned income is income of minus 20 lakh. Your income assessed under 143.1 is minus 10 lakh. Now, in my understanding, the penalty should be levied only on 20 lakhs. That is 10 lakhs income assessed, and to that add the 143.1 returned assessed loss of 10 lakh. The underreported income should be determined at 20. Income is assessed for the first time, and if return has been furnished, then the difference between the income determined under 143.1 and 143.3 or 144. And it says where no return is furnished, and in any other case. So what if somebody were to take a view that this should fall under any other case? I think that is a little far-fetched, and I would think the penalty should be levied only on 20 lakh, not on 30 lakh. Next is, you will again go back to the language in 270 capital A, which very clearly provides that the penalty can be levied by the assessing officer, by the principal commissioner of income tax, by the commissioner of income tax, or the commissioner of income tax appeals. And we discussed that the assessing officer will initiate this penalty in the course of assessment proceedings. The commissioner appeal, if he enhances it in proceedings of appeal, the commissioner or the principal commissioner, where an enhancement happens in terms of 263 of the Act, where there is a revision of the order. In such cases, the penalty will be levied by the respective people. Now, before we go further, you also have to look at how the penalty is worded. The variance is worded in subsection 2 and subsection 3. Subsection 2 says the income is assessed. Then, if it is greater than 143.1, that amount, there is a difference between 143.1 determined income and 143.3 determined income is the concealed or is the underreported income. Unfortunately, by force of habit, I am still using the word concealed. It is underreported. Now, there can be two situations that one can envisage. One, supposing I have returned an income which is below the maximum amount not chargeable to tax, and my income is also determined under 143.1 at the same level. Let's say I have returned an income of 1 lakh, income is assessed also at 1 lakh under 143.1. I am an individual who is entitled to a basic exemption of say 3 lakh. So 2 lakh of basic exemption remains unexhausted at that stage. Supposing my income is determined at 6 lakh. Now what should be my underreported income? Logically, it should be only 3 lakh. But since my income is assessed for the first time, one can say that the underreported income arithmetically as determined under 270A will come not to 3 lakh but 5 lakh, because the income of 6 lakhs which is assessed minus what is already determined under 143.1 of 1 lakh will become my underreported income. This results in an unfairness. See, when I used to study chartered accountancy, my then teacher used to tell me that law does not work with the precision of English. and English does not work with the precision of mathematics. Law is slightly different from English. It can have a different meanings may arise. And in mathematics, it is not even, English does not even work with the precision of mathematics. See, in fact, he used to give this example. I'm sorry if I'm, overstepping, but then this is an example which I learned. In mathematics, if A is equal to B and B is equal to C, then A is equal to C because B and B stand cancelled. Now in English, I love my wife loves her mother. We cannot cancel the wife and say, I love my mother-in-law. I don't have to. I can, of course I can. There is no quarrel about it. But it need not necessarily be true in English. Now, unfortunately, they seem to have couched 270A in an arithmetic language, saying you subtract two numbers, whatever you get as a resultant, that subtracted number is the amount of underreporting. So that leads to one confusion. The second confusion, as I said, the commissioner appeal can levy penalty while he is enhancing the income in the course of appellate proceedings. So if I accept this, which is clearly provided for, I would say, then there seems to be one more catch here. So let's assume the income is determined at, say, 10 lakhs by the assessing officer. I returned an income and the income was determined under 143(1) at a figure of, say, 6 lakhs. I returned an income of 1 lakh, 6 lakhs, 143(1) 6 lakhs, 143(3) 10 lakh, 4 lakh addition. So 4 lakh is the underreported income. I will be liable for a penalty probably on that. Now, the Commissioner Appeals wants to enhance my income and he wants to determine my income at, let us say, 18 lakh. At 18 lakh. Now, which clause of subsection 2 or subsection 3 does it fall under? Now, it says, for example, subsection 3, it says, if a return is furnished, then the difference between the income determined and the income originally determined under 143(1). Now, the income determined here is 18 lakhs, 143(1) is 6 lakhs. Can one say the escaped income or the underreported income is 12 lakh? The answer should be no. The underreported income should be taken only as 8 lakhs because on that difference of 4 lakh, the assessing officer could have levied a penalty or would have levied a penalty under 270A. If I compute it at 12 lakhs now, on that 4 lakh, there will be a double penalty. That cannot be possible. That cannot be possible. Right? That is one lacking. But if one were to say no, it falls under any other case, the income assessed minus the income already assessed. Is the commissioner framing an assessment? The answer may be no. He is only enhancing the income which has already been assessed. So they don't seem to have worked out an arithmetic on what will happen when there is an enhancement, either by the commissioner appeal or the commissioner. Whatever I gave as an example in the context of commissioner appeal may apply with equal force even with a commissioner appeal. So these are aspects which need a lot of clarity. Unfortunately, the law is lacking in clarity in these cases. I will go on to explanations 4 and 5. Explanations 4 and 5 are similar to explanation 2 to section 271 1C. I explained explanation 2 to 271 1C as a mechanism by which a source credit is taken. I gave an example. Income is, there is an unexplained credit in the financial year 13-14, assessment year 14-15, which is added, but penalty is not levied. In financial year 15-16, assessment year 16-17, you try to take credit as for source for that credit which was added by capitalizing that amount of credit to your capital account. Penalty is levied in the assessment year 16-17 because you are seeking to take source in that year. That is the scope of explanation 2 to 271 1C. The same thing is provided for in explanations subsections 4 and 5 of section 270 capital A. Subsections 4 and 5 of 270 capital A. Now, before we proceed, there is one unfortunate lacuna, or we should probably, since we are mostly arguing for the SSC, we must say there is one fortunate lacuna, because there seems to be a gap in that penalty cannot be levied in certain circumstances. What is that? What is that? Now let us assume in the financial year 13-14, assessment year 14-15, an addition was made towards an unexplained credit of 10 lakh. But penalty was not levied in financial year or in assessment year 14-15. I gave you an example. I am trying to take credit in 16-17 assessment year, then penalty can be levied in 16-17. Now, supposing I am trying to take credit not in 16-17, but in 17-18, what happens? What explanations, subsections 4 and 5 of 270A provide for is only where there is an addition which is made in a year relevant to a year where 270A is leviable, but penalty is not levied, and you seek to take source credit in a subsequent year. It does not talk of a situation where it does not contemplate of a situation where the penalty was not levied under 271(1)(c). Please remember that the scope and ambit of 271(1)(c) is completely different from the scope and ambit of 270A. 270A is dealing with underreporting and misreporting. 1C is dealing with concealment and furnishing of inaccurate particulars. Now again, when you come to 270 capital A, you have to determine, which I will come to in a while, you have to determine whether the income is said to have been underreported or misreported. You have to determine whether the income is said to have been underreported or misreported. Right? So, if there is a addition under say 68 in a 271(1)(c) regime or era, then that cannot be transposed into 270A, unfortunately, and assessees can get away with the rigors by making the credit, so taking the source credit in 17-18 or thereafter in respect of intangible additions made in earlier years prior to 17-18 and where penalty has not been levied in those years. So he will escape the penalty under 271(1)(c) also, because 1C is leviable only when the addition, when the source credit is taken. But 1C is not applicable for that. I am assuming a situation where in 16-17 assessment year addition was made under section 68, penalty was not levied. In 17-18 I am taking credit. Penalty under 271(1)(c), the law says is leviable in 17-18. But in 17-18, 271(1)(c) is already become inoperative. 270A is applicable. Can anybody levy 270A? The answer may be no, because the penalty is leviable if at all only under 271(1)(c). This appears to be one more lacuna. Now going on to subsection 6 of section 270A. Subsection 6, it says the underreported income for the purpose of this section shall not include the following, namely, right? And gives us a list of 5 items. 5 items. Actually, there are, I should say, there are 4. The 5th item being only a matter of abundant caution. Right? I'll explain what that means. So you have certain items which are not said to be underreported income. So logically speaking, if something is not underreported, that cannot be misreported also, because I said the language in subsection 8 onwards talks about misreporting as a underreporting as a result of misreporting. So underreporting is a larger term. Misreporting is a part of underreporting. Okay. So once we understand this as the principle underlying, then logically the next thing follows. When can we say that there is no underreporting at all? Because the minute I say there is no underreporting, that cannot be a misreporting logically. So when can I say there is no underreporting? Subsection 6. Now, before I proceed to the items listed out in subsection 6, if you see the language in subsection 6, it says the underreported income for the purpose of this section shall not include the following, namely. Now, the language used is shall not include the following, namely. So, first of all, we have to understand or dwell upon whether subsection 6 is exhaustive in nature or illustrative in nature. If you say that subsection 6 is exhaustive, then only the exceptions covered by subsection 6 can be said to be non-underreporting. If you say it is illustrative in nature, then one can say that it is not only the illustrations that are given in one subsection 6, but can expand further also. Before we go to what it can be expanded into, possibly, we look at the language. It says, shall not. Subsection 6 says, shall not include the following, namely. Now, two clues come to me. One, the language used shall not include. So, the word include and the words shall not have to be understood. And it says, shall not include the following, namely. The word, the term namely, the word namely. Now, normally I would understand that when we say namely, it is always illustrative. Right? It is always illustrative. One cannot say when the use of the word namely is there, it is still exhaustive in nature. So, to my understanding, the circumstances prescribed in subsection 6, which use or which provide for certain exclusions from underreporting, are not exhaustive but illustrative. We can also look at the words shall not include. There is a very interesting decision of the Supreme Court in the context of Bombay Rent, Hotel and Lodging House Rates Control Act. It is rendered in the context of the Bombay Rents, Hotel, Lodging, Housing Rates Control Act, where in section 13(1)(g) a similar language is used. It says, it defines landlord and states, landlord shall not include. Landlord shall not include a rent farmer, a rent collector, or an estate manager. So it says what it shall not include. Now the Supreme Court went on to look at whether a person who is a mortgagee in possession will qualify as a landlord because it is not specifically excluded. The Supreme Court said yes, it will be. Right? So going by that language of the Supreme Court also, one can probably take a clue and say that the items mentioned in subsection 6 are only exhaustive. Now, what are the items mentioned in subsection 6? Clause A, the amount of income in respect of which the assessee offers an explanation and the assessing officer or the commissioner appeal or the commissioner or the principal commissioner, as the case may be, is satisfied that the explanation is bona fide and the assessee has disclosed all material facts to substantiate the explanation offered. This is similar to your explanation 1. Explanation 1 to 271(1)(c), it's very similar. Now, if you go to explanation 1 to 271(1)(c), it talks about fails to offer an explanation, offers an explanation which is found to be false, or offers an explanation which is not able to substantiate and fails to prove that such explanation is bona fide. Now, this is in the affirmative. Now, here they talk about the assessee offers an explanation. So, they are not talking about a situation where he offers no explanation or an explanation which is found to be false. He offers an explanation and that explanation is found to be bona fide and all material facts to substantiate the explanation are offered. Now, here there seems to be one aspect that we will have to bear in mind. when we say all material facts to substantiate are placed on record, it can only mean such facts as are in my control. Facts which are beyond my control cannot be asked to be placed by me. Right? So this is similar to your explanation one in a way, but slightly broader in the sense that here he need not find it to be false. The minute you are offering an explanation, and if you are not able to demonstrate it is bona fide and also place all material facts, you are liable for penalty. So you must prove that it is bona fide and also disclose all material facts to substantiate the explanation. Only then you are outside the ambit of subsection 6 by virtue of clause A. To say that you are not one who has underreported income. B, the amount of underreported income determined on the basis of an estimate. If the accounts are correct and complete to the satisfaction of the AO, the Commissioner of Appeal, the Commissioner, or the Principal Commissioner, but the method employed is such that the income cannot be properly deduced. This seems to be somewhere very complicated to my mind, because if I have maintained my books of account properly, right? If my method of income is proper, then why should I go on an estimate? And why should that estimate get redetermined? Because it is not correct and complete. This seems to be $1 million question in my mind. I possibly cannot imagine any situation, excepting in the case of a builder who is following AS7, percentage of completion or completed contract, percentage of completion. Only he will maintain books and then estimate income. Otherwise, why should I maintain books which are correct and complete and then estimate my income? And then you are not able to determine the income correctly and you will re-estimate my income. I can't imagine a situation like that, but that is also something which is contemplated. Honestly, I have been at a loss to understand what they mean or what they are trying to cover by explanation or by subsection clause B, except that in the case of a builder maybe yes, AS7, and that may be a situation. Clause C, the amount of underreported income is determined on an estimate if the assessee on his own estimated a lower amount of addition or disallowance and on the same which has been included in the computation of income and has disclosed all facts material to the addition or disallowance. So the assessing officer is increasing my estimate of disallowance or increasing my estimate of income, where I have also estimated the disallowance or the income. Then in such a case, probably they are saying penalty is not leviable. Now there are a number of decisions, particularly from various high courts, including the Punjab and Haryana High Court in many cases, to say that estimated additions cannot be the subject matter of levy of penalty. Estimated additions cannot be the subject matter of levy of penalty. So that being so, I think this clause C is trying to get over that, to say that if you have estimated, I am also estimating, only then subsection 6 will operate so as to exclude the person from having been said to have underreported income. Clause D, the amount of underreported income represented by any addition made in conformity with the arm's length price determined by the TPO, transfer pricing officer, where the assessee has maintained information and documents as prescribed under 92D, declared the international transaction under Chapter 10, and or disclose all material facts relating to the transaction. Right? Now, if you see here, it talks about an underreporting represented by an addition as a result of arm's length price determined by the TPO in relation to an international transaction. This is similar to your explanation 7 maybe, to say that that amounts to a concealment of income. I'll come back to this clause D when I deal with subsection 9. But before that, I will finish off with subsection 6, 7, and 8. Now, subsection 6 also provides that where the amount of undisclosed income is referred to in 271 AAB, that will not be liable for 270 capital A. 271 AAB deals with intangible additions which are made in terms of section 68 to 69D. Unexplained credits, unexplained investments, investments partly recorded, unexplained expenditure, etc. So if a particular income falls under 271 AAB, 271 AAB deals with search cases. So where you are searched SSC and where there is undisclosed income found as a result of the search, penalty will be leviable under 271 AAB. I will come back to this. This will be only in respect of specified previous years. I will come back to this as well. Now, interestingly, you don't find a reference to 271 AAC here. Now, if you look at the language in 271 AAC, it says, the assessing officer may, notwithstanding anything contained in the Act, other than the provisions of 271 AAB. So 271 AAC overrides all provisions of the Act other than 271 AAB. Right? But 270A does not talk about not levying penalty where AAC is attracted. In fact, one officer who was discussing with me said, if you are searched, I will levy penalty under 271 AAB in respect of your undisclosed income. But if you are not a person searched, and if you are a person in respect of whom an intangible addition is made, I will levy penalty under 271 AAC also. And I will levy penalty under 270A also. I do not know why 270A subsection 6 does not refer to AAC. They could have very comfortably referred to AAC also. They seem to have omitted that. But then to my mind, in a case where 270 AAC is applicable, that is additions are made under 68 to 69D, to my mind, it is penalty under 271 AAC which is leviable and not 270A. That is because of the language used in AAC, which says notwithstanding anything contained in this Act other than the provisions of AAB, 271 AAB. But then 271 AAB itself talks about overriding all the provisions of the Act. Talks about overriding all the provisions of the Act. It says the assessing officer, notwithstanding anything contained in the provisions of this Act, direct that. So, while 271 AAB is overriding all provisions, if they could refer to that in 270 capital A6, why did they not refer to that in 271 AAC in 270A? It seems to be a doubt that has been raised in some quarters. Of course, my view is that if an addition is made under 68 to 69C, the penalty is leviable under 271 AAC and not under the provisions of 270 capital A. Now, subsection 7 makes it clear that the penalty for underreporting will be 50% of the tax on the underreported income, tax payable on the underreported income. Subsection 8 says that if there is an underreporting as a result of misreporting, penalty will be leviable at 200% of the tax on such misreported income or underreported income, which is arising as a result of misreporting. So, underreporting 50% of the tax on underreported income, misreporting 200% of the tax on the misreported income. This is what subsection 7 and 8 provide for. Subsection 9 deals with what is misreporting. Subsection 9 deals with what is misreporting. There, they talk of different circumstances and provide that these are circumstances of misreporting. They specifically provide for 6 circumstances. I'll just read out the 6 circumstances one by one and try to explain. A, misrepresentation or suppression of facts. Here they say misreporting shall be the following. That means this is an exhaustive list. This is not an illustrative list. So if something does not fall under subsection 9, That is not an underreporting as a result of misreporting. That would at best be an underreporting, not misreporting. Subsection 9 is clearly exhaustive in nature. So we are talking about cases of misreporting of income, which shall be the following. Which are these? A, misrepresentation or suppression of facts. Misrepresentation or suppression of facts. Now, this is a term, I think, or a term which any of us would understand, where we are suppressing facts or misrepresenting facts, which is a positive act where you are seeking to suppress or misrepresent. So if there is a legal interpretation issue, that cannot fall here, because they are only talking of misrepresentation of facts, not of law. Nobody can misrepresent or suppress law. B, failure to record investment in the books of account. I'll come to each one. Claim of expenditure not substantiated by any evidence. C. D, recording of any false entry in the books of account. Recording of any false entry in the books of account. E, failure to record any receipt in the books of account having a bearing on total income. I do not know why they should say having a bearing on total income, because ultimately your penalty is going to be dependent on the income assessed minus the 143(1) income, say. So if it does not have a bearing on your total income, automatically your income that will be assessed will be the same figure. And therefore penalty, whatever percentage you may compute, will not be applicable at all. So I don't understand why, but they have been very careful. They have been extra zealous, I said, in drafting many of these provisions. Failure to record any receipts having a bearing on total income. And F, failure to report any international transaction or any transaction deemed to be an international transaction, or any specified domestic transactions to which the provisions of Chapter 10 apply. Now let's go back and see how we understand each one of these. I already discussed about misrepresentation or suppression of facts. B, it says failure to record investment in the books of account. If there is a failure to record investment in the books of account, in my understanding, the addition will fall under either 69 or 69A. If it falls under 69 or 69A, in my view, 270A is not invocable, but 271AAC is invocable. Your tax rate will fall under 115 BBE at 60% plus a further surcharge of 25%, making it a 75% tax. And there is a further penalty which will be 10% of the tax, which is 10% of 60% or 6%. So your total effective tax liability in such a case should come to 81% including penalty. I would not understand why they have referred to a failure to record investment in the books of account here. Because in my view, in such circumstances, AAC should be 271 AAC should be applicable. Claim of expenditure not substantiated by evidence. Now, for each and every expenditure, to expect evidence to be kept itself seems to be a little far-fetched. For example, if I were paying my sales representative some auto fare, what evidence will I have? At best, I will have self-made vouchers. I might have a declaration from my sales team guy, but I will not have any evidence as such. Each and every expenditure cannot be backed only by evidence. It may be impossible. There might not be possibility of getting evidences in certain cases. I've just given one example. I don't know why they have put it in such a strict term that it is not backed by evidence. The minute it is not backed by evidence, you are saying it is misreporting, and my penalty will be 200% of the tax. I think this should also be liberally interpreted. I will come to clause D, recording of false entry in the books of account after I deal with 271 AAD. For the time being, I will not talk about this. 5 or E, failure to record any receipt in the books of account having a bearing on total income. In my view, having a bearing on total income was a superfluous term which need not have been used. They are superfluous words. Even without that, only if it has a bearing on total income, 270A penalty will be quantifiable. Lastly, failure to report any international transaction or transaction deemed to be an international transaction or a specified domestic transaction to which the provisions of Chapter 10 apply. Now, you're all aware that there are international transactions, there are deemed international transactions, 92A1 and 92A2. Now, both of these are sought to be covered. Likewise, deemed domestic transactions, which are specified domestic transactions. Earlier, 40A2 transactions were also covered. Now, 40A2 is outside the ambit, but 80IA8 and 80IA10 kind of transactions are covered. So, these can be said to be underreporting if you have not reported an international transaction. Now, look at the language in subsection 6. I said I'll come back to that. The amount of underreported income represented by any addition in conformity with the ALP determined by the TPO, where the SSC has maintained information and documents as prescribed in 92D, declared the international transaction under Chapter 10. It does not talk of deemed international transaction. It does not talk about domestic transaction, specified domestic. So does it mean that in every case, there will be no exclusion at all? In my view, no. Because subsection 6, please remember, creates exclusions. So if one were to interpret it very strictly, then specified domestic transactions, etc., where there is an addition and where you have maintained all documents, etc., will not go outside the ambit of subsection 6 or 270A, and consequently penalty may be leviable for underreporting, but that should not be the interpretation. To my mind, even specified domestic transaction and deemed international transactions should be understood as falling within clause B of subsection 6 and can be, taken as part of the exclusion But unfortunately, the language used does not seem to very clearly state that that is excluded. Right? That is what I am trying to point out. This seems to be again a drafting lacuna, and that should not be the interpretation that should be taken. Likewise, it talks of a claim of expenditure not substantiated. Now, under this clause, you can see that only expenditure not substantiated can be covered. Right? So, if there is a failure to record any receipt in the books having bearing on total income, clause E can cover. But if you have taken a particular amount into the books of account, but not taken it in the income, for example, a credit, an unexplained credit, which is shown as a loan creditor, say, it is found in the books of account. But is not treated as income, but the officer treats it as income. Can subsection 9 apply? The answer will be no, because clause E only talks of a failure to record a receipt itself. I have recorded the receipt. You are not accepting it to be a credit, you are saying it is income, but the receipt is recorded all the same. Therefore, in my view, subsection 9 will not apply, so it cannot amount to a misreporting. It should result in an underreporting. But then, will 270A apply or 271 AAC apply? The same old doubt. To my view, AAC should apply, not 270A. So there seems to be a lot of drafting lacuna in subsection 6 and 9 also. Subsection 9 also refers to various aspects relating to international transactions and so on and so forth. At this stage, we should not forget two other sections, 271AA and 271G. 271AA deals with levying a penalty at 2% for failure to report an international transaction. And 271G seeks to levy a penalty at 2% of the value of international transaction, where there is a failure to produce the documents, etc., or information. I'm now referring specifically to 271AA, failure to maintain or report an international transaction. 2% of the value of the international transaction. 270 capital A says that this is a case of misreporting. Now, which section should I? Should I apply 270 capital A or 271AA? Or should I interpret it as understanding that wherever there is a variation in the income, that will fall under 271, 270A. If there is no variation of income, 271AA will apply. I would think that that is not a correct interpretation either. They seem to have overlapped in the sections. Of course, I will come to subsection 11 of section 270A and I will deal with this over again. Right? So this is again one area which requires a lot of clarification. Next is with regard to quantification of tax payable. Now, with regard to quantification of tax payable, the provisions of 271(1)(c) said 100% to 300% of the income that is sought to be evaded. 100% to 300% of the tax on income sought to be evaded. Here they have gone to mathematics. As I said, mathematics is a little dangerous. When you are talking of law and trying to marry it with mathematics, it doesn't work so simply. But then they are contemplating three situations where the assessee has not furnished the return of income and the return is furnished for the first time under 148 and where the income is assessed for the first time, then the income assessed plus the maximum amount not chargeable to tax as if it were the total income. So your income is assessed under 148. Your income, your tax on income will be the tax on the income which is assessed as increased by the maximum amount not chargeable to tax. If income is already assessed, then you subtract the income already assessed in determining the quantum of income that is said to have been underreported. If the income has been assessed under MAT or AMT earlier, that amount should be subtracted in determining the amount of income that is to be taken as the underreported income, and the tax thereon should be computed. Now, subsection 10 has not contemplated what will happen in case of certain variances. Supposing the variance is as a result of MAT or AMT, what is to be done is not clarified, clear, it is not made clear, except by saying in any other case. Will that cover AMT and MAT is a question that has to be answered. So to that extent, there is a problem with subsection 10. Now, subsection 11 says no addition or disallowance of an amount shall form the basis of imposition of penalty if such addition or disallowance has formed the basis for imposition of penalty in case of a person for the same or any other assessment year. So if one income has been penalized under a different provision or in a different year, that will not lead to, or that same thing amount should not be penalized under 270A also is provided for. Now, this can be read in the light of 271AA, transfer pricing. Documents not maintained or not reported. Since 271AA is applicable, can one say 270A is not applicable? Or does the officer have the choice now to decide, okay, I will go by 270A or I will go by 271AA? But the law as it stands, it lacks clarity. It appears that there seems to be some kind of a confusion in the minds of the lawmaker as to which of these provisions should be invocable in such cases. Now, the other issues on 270A I will quickly deal with, or rather I will take only one more issue on 270A as a global level. Now let's assume, because the law is contemplating of underreporting and underreporting as a result of misreporting. And in my understanding, the assessing officer, in respect of each and every addition that he is making, should state whether it is an underreporting of income or a misreporting of income. That addition that he is making Is it an underreporting or is it a misreporting? He should state so. Why? I will come back. I will come back. But at this point, it is my view and my understanding that he should definitely state which edition is underreporting, which edition is misreporting. Now, there seems to be one more difficulty. Supposing the assessing officer makes two additions. Let's say 10 lakh, one addition, 14 lakh, another addition. And at the same time finds that some other claim of deduction should not have been allowed. Should be allowed rather. He varies my income. By reducing it by, say, I said 10 lakh one addition, 14 lakhs one addition. Now let us say he is going to 3 lakh he is going to allow, despite my not making a claim, which anyway in my understanding he is bound to do. Now, should this 3 lakh be subtracted from the underreporting or should it be subtracted from the misreporting? God only has the answer to this question. Because ultimately, the underreported income is nothing but the income finally determined as subtracted by the income that is already assessed or the income that is determined under 143(1). And he has now divided it into underreporting and misreporting, because for underreporting the penalty is 50% of the tax and for misreporting the penalty is 200% of the tax. So he has to divide it. That's another aspect that one may have to bear in mind. There is a third adjustment. What happens? Which goes to reduce the income. What happens in such case? Now I will pause here for a little while in so much as 270A is concerned. I will probably have to come back to bits and pieces of 270A as I deal with 271A, B, AAC and AAD. Now we'll go to 270AA, which provides for immunity from imposition of penalty under 270A and also from prosecution under 276C and CC. 276C and CC, and also the provisions of 270, and also the provisions of 270A. Now, what does this provide for? The provisions of 270AA, what does it provide for? 270AA contemplates of not levying or giving an immunity from penalty in certain cases. And when does it want to give an immunity? It talks of a situation where the assessee has paid the tax and interest demanded as per the order passed under 143(3) or 143(3) read with 147 within the time allowed in the notice of demand. Within the time allowed in the notice of demand. He should have, within the time allowed in the notice of demand, paid the entire amount of tax and interest. That is condition number 1. Now, going by that, the next aspect. Having said that, the second condition is no appeal should have been filed by the assessee against the order referred to in subsection 1. Against the order referred to in subsection 1, that is against the order in respect of which you are seeking the immunity from the penalty under 270A and prosecution under 276C and CC. So condition number 1, you should not have an order under 144. You should have an order under 143(3) or 143(3) read with 147. If it is a best judgment assessment, you are not entitled to an immunity under the provisions of 270AA. And you should not prefer an appeal against that order which is referred to, against which you are filing the immunity application. Now, this immunity application is to be filed in form number 68 within 1 month from the end of the month in which the order is received. 1 month from the end of the month in which the order is received. And the order granting immunity is to be passed within 1 month from the end of the month. 1 month from the end of the month in which the application is received. Either granting or refusing to grant the immunity. Now, nowhere does 270AA talk about giving an opportunity of being heard, right? In a case where he is going to allow the application. So if he is proposing to reject, then he should give you an opportunity of being heard. Now, please understand, there is a lot of confusion in 270AA as well. Because it says you should present the application in form number 68 within 1 month from the end of the month in which the order is received. The AO should pass an order within 1 month from the end of the month in which the application is received. Right? And he can either grant or decline to grant. Now, my order may not contain only one addition. My order may contain multiple additions. If all the additions are only under reporting, there is no difficulty. I can go and pay the taxes and the interest and claim the immunity. What if let us say 2 additions are made? One addition is an underreporting of income. The other addition is a misreporting. Obviously, if you go further into the provisions of 270 AA, it clearly says that no immunity shall be granted in circumstances contemplated by subsection 9 of section 270A. That is misreporting. So for misreporting, no immunity. So if I go for an immunity in such cases, where there is an underreporting, if there is only misreporting, anyway, he is not going to grant me immunity. If there is underreporting, he will grant me immunity, let us assume. If there is underreporting and misreporting, what does he do? He can only obviously grant me immunity in respect to the underreporting. So on the misreporting, automatically I am opening up myself to penalty, because the law provides that I cannot file an appeal if I file a form number 68. They are mutually exclusive. If you choose to go in appeal, you cannot come for immunity. If you come for immunity, you cannot go for an appeal. You cannot go for an appeal under 246A. That is what is provided for. So this seems to be one other difficulty. So if I have underreporting and misreporting, the immunity doesn't work for me, because the order is the order which cannot be subjected to appeal, not the issue. If they had made it issue-wise, then it would have been better, because for wherever there is an underreporting, I would have gone for immunity wherever I choose to, and wherever there is a misreporting, I can pursue it in appeal. Now, in every case, a cease will be forced to pursue it in appeal. Now, one more thing you need to be careful is, if you are present in an appeal, you cannot come here under the scheme of 270 AA. The next aspect in respect of 270 AA is that if you see the language, it doesn't appear that the assessing officer in the context of 270 AA can decide whether something is a misreporting or an underreporting. That decision should be taken in the course of proceedings of assessment itself. Right? It should have been taken in the course of assessment. Can he, in the course of assessment, say something is a misreporting, but later on say, no, it is only an underreporting? Or vice versa. Say it is an underreporting in the assessment, but say while passing the order under 270 AA, say, no, it is misreporting. In my view, that issue cannot be gone into at all in the course of 270 AA. In the course of 270 AA, what can he see? Whether I have paid the taxes and the interest within the time allowed, whether I have been without presenting an appeal. This is my understanding of 270 AA, and he cannot travel beyond this, because then he will be passing the final order of penalty under 270A by saying, no, it is misreporting or underreporting. Then what will he do in the final order when he is going to pass levy the penalty under 270? Please remember, assessment order, then you are going under 270 AA. Later on, the 270A order will come to be passed. Right? So this is another aspect which has to be borne in mind. Now, the next aspect is with regard to the time for filing appeal. Supposing the law very clearly provides in the second proviso to 249(2)(b) that if the immunity is rejected under 270 AA, the time starting from the date on which you filed the application under form number 68, in form number 68, to the date of rejection will be extended. So which means that if I moved an application today under 270AA and say 10 days from today, the commissioner, the assessing officer rejects my 270A, then what happens? What happens will be that automatically this 20 days will stand excluded. But then let me take a slightly different example. Forget this pandemic, forget the extension of time limits that have been made by the notifications. Just for an example, let's say on 31st December an order is passed, 31st December 2019 an order is passed for assessment year 17-18 and served on me on 1st January 2020. My time limit is 30 days from the end of that month for filing the form number 68. So my time limit will be 28 days of February. I have got the order on 1st January. So January, end of that month, 31st January, 28 days of February and 2 days of March. Right? So on 2nd March, I can move my form 68, latest. He has 30 days from the end of that month. That means he has time till April 30th to pass the order. Now, supposing on April 30th, he rejects my application. The time that stands extended is only from 2nd March to 30th April. That is the date I moved my application, that is 2nd March, to 30th April when he passed the order. Now, my time limit for filing the appeal in the normal course is 30 days. So, I should have, in the normal course, filed my appeal within 30 days from the first day of January, that is by 30th January. So, from 30th January to 2nd March, there is no exclusion. So, for that, I have to file a condemnation application. They should have contemplated the time starting from the date of receipt of the order. In a case where an application is made, from the date of receipt of the order under 143.3 or 143.3 read with 147 to the date on which the final rejection is made. Unfortunately, that's not what is contemplated. That is not what is contemplated. Likewise, as I said, there is a bar. There is a bar against going in an appeal once you go under this scheme and get the immunity, because it says no appeal under 246A or an application for revision under 264 shall be admissible against the order of assessment or reassessment referred to in subsection 1 of clause A of subsection 1 in a case where the order under subsection 4 has been made accepting the application. So if your application is rejected, you have the option of going under 264 or 246A. But if your application is accepted, then you don't have that option. Now, what does this mean? Now, there are circumstances where there is a direct appeal to the tribunal. For example, an enhancement made by the commissioner under 263. There is no bar on going an appeal to the tribunal under 253. The bar is only for 246A and 264. There is no bar for 253. I do not know why the lawmaker has not contemplated that. They should have. Right? So let's assume there is an underreporting and a misreporting in an enhancement. Two enhancements made by the commissioner under 263. For the underreporting, I will go to the assessing officer. For the misreporting, I will go to the tribunal, which I cannot do if it is an appeal to the commissioner. Likewise, what happens to DRP proceedings where there is a direct appeal to the tribunal? There also there seems to be no bar on going against both. One other very important aspect which I will quickly deal with, is to say that 270AA, which seeks to grant an immunity, not only grants an immunity from penalty, but also from prosecution under 276C and CC, which I referred to. But then, one other aspect that is not very clear, I think complications will grow as time starts. In fact, Mr. Ramurthy, when we were talking before the commencement of this session, saying with faceless assessment, one may end up with more litigation than before also, which also seems to be a possibility. Because it may be very difficult to make a person understand what exactly is the transaction over just corresponding by an email, one. And two, likewise, there are area-specific issues. Area-specific issues. For example, the business done by a businessman in Charminar in Hyderabad can never be understood by an officer sitting somewhere in Lucknow, because he does not know how the business happens there. Right? I'm just giving this as an example. There are thousands of such cases because, see, various businesses are concentrated in different places. For example, marine export is concentrated in Kerala. It is concentrated in Kerala. How would I expect an officer sitting in Bhopal, who is in the e-assessment, to understand how marine export happens out of Kerala, how shrimps are taken out of the sea, and how they are cut and weeded and processed before they are exported. A lot of issues may arise. But that apart, very simple issues. Supposing there is a demand raised, and that is a clear case of underreporting of income. But let us assume you find, according to you, a mistake apparent. You find a mistake apparent. He has made an addition which is not required. So you move a 154 petition. Now, should I go for immunity for that also? Because the 154 is unlikely to be passed within this time span. For 154, the time limit is 4 years from the end of the financial year. Even if you take into account the charter that has been introduced by the Prime Minister, it only requires that orders should be passed expeditiously and within the time. Where is the problem? The problem lies in the fact that I may not have a 154 order in hand. Now, how much should I pay? Should I pay including the amount that is in the 154, etc.? And supposing the officer grants me the immunity, will I get a refund later when the 154 is passed? Or can I pay a lesser amount? Because the law says whatever is stated in the notice of demand, the entire amount should be paid. It does not contemplate of a 154, etc. that can be made. A 154, etc. that can be made. Or what happens in various situations? It says you cannot move the commissioner under 264. I cannot move the commissioner under 264 for a revision. But the commissioner suo motu has the power, because it says no application for revision shall be admissible. No application for revision shall be admissible. What does that mean? Does it mean that I can, have a case where there will be a suo motu revision? Then what happens? I have got immunity, I have paid all the taxes. What will you do after the 264? Grant me refund? If the commissioner takes it suo motu, because 264 contemplates suo motu, and also a case where the provisions are invoked by the assessee. These are aspects that have to be borne in mind. I'll quickly deal with 271 AAB and AAC, and wherever required, again touch upon the aspects that are relating to 270A in that context also. AAB deals with has two subsections. I'll put it this way: subsection 1 and subsection 1A. Subsection 1 is in respect of searches up to 15/12/2016, where the penalty was graded. It was 10% if the 10% of the income, if the assessee declares the manner in which he earns the income and also pays the tax and interest before the specified date. And also states the manner, declares the income, states the manner in which he earns the income and pays the tax and interest. 20% if he only declares the income but does not state the manner in which he earns the income and pays the tax and interest. Earlier it was 30 to 90% in other cases. That was later on by the Finance Act 2016 made 60%, one flat rate of the tax. Now, with effect from 15/12/2016, searches made on or after 15/12/2016, it is 30 or 60%. If you state the manner in which you earn the income, declare the income and pay the tax and interest before the due date for filing the return of income has ended, then it is 30%, otherwise it is 60% of the income. Please, not of the tax. So these are the penalties under 271 AAB. And 271 AAC, I have touched upon where additions are made under 68 to 69D, 10% of the tax on the addition. So I already explained this, that will effectively amount to about 6% because the tax rate will be 60%. And this is applicable from assessment year 17-18. Interestingly, you will notice that this came by an amendment act as a result of demonetization. The act came into force sometime in December, but the penalty is applicable in respect of all transactions purportedly from 1st April. To my mind, this can only apply after the amendment came into force for assessment year 17-18. I have already discussed about different aspects of AAC, AAB in the while I was discussing 270A. But before I proceed further, remember that penalties can be under different provisions. For example, in a search assessment, let us say, there is income found as a result of search. Whether that income is a regular addition or an addition under 68 to 69D, the penalty will be under 271 AAB because AAB overrides the whole of the act. Okay? But in a search assessment, it may also be possible that regular additions may be made. For example, there might be a TDS non-compliance and therefore an addition made under 40A1 or 40A1A. For that, will penalty be exigible under 271 AAB? The answer is no. The answer is no, it will not be, it will fall under 270A. Likewise, not arising as a result of search intangible additions made, penalty will be leviable under 271 AAC. Because if you read the provisions of 271 AAB, it only refers to a case where the income is found as a result of search because they are contemplating of different levies where the search is made. And the income is arising as a result of the search. Because if you declare the manner in which you earned the income, etc., that can only be for incomes found in the result of search. In the same light, there are two other aspects that you must notice. Please note that 271 AAB does not refer to 132A, that is a requisition. I do not know why, because everywhere in the Act you will find that search and requisition are treated on par. But in 271 AAB, they have referred only to a 132 action, that is a search action, not to a 132A. So a 132A action is not governed by 271 AAB, but will be governed by 270A if at all. That is one. Two, in the context of 271 AAB and AAC, there is also one other very interesting aspect which I find. 270A says the penalty can be levied by the assessing officer, the commissioner of income tax appeals, the commissioner or the principal commissioner. But here they talk only of the assessing officer. So what if an enhancement is made, which is falling within the realm of 271 AAB or AAC by the commissioner or the commissioner appeal or the principal commissioner? Should we understand that penalty is not at all leviable? In my view, yes. There is no mechanism for such a penalty to be levied in such circumstances. So such a view is definitely one that can be canvassed. This seems to be a conspicuous absent. Likewise, if you go to 271 AAB, they say you must have stated the manner in which you earned the income under 132.4 in the 132.4 statement. Now, 132.4 statement is made by me, who is the searched party who has earned the income. So, if you are my employee, say, and you have confessed the manner in which they earned the income, that will not exonerate me. But what if the assessing or the concerned authority has not even raised a question as to how you earned the income? Courts have held that in such circumstances, since no question has been raised, the lower rate of 30% can be charged. Earlier it was 10%. Before that it was nil also. So such amount can be, reduced rate can be levied. So these are aspects relating to 271 AAB and AAC. But for the time being, you will remember the 271 AAB, AAC, or for that matter, the section that I am going to deal with, 271 AAC, AAD also does not contain any mechanism for a commissioner appeal the principal commissioner to levy the penalty. Now, before I proceed further, remember that the immunity under 270 AA is only for 270A, not for AAB or AAC. Likewise, the immunity under 270A is granted, AA is granted by the assessing officer. Even though an enhancement may be made by the commissioner, even though the levy of penalty is to be made by the commissioner, immunity is to be granted by the AO. So the minute he makes an enhancement, you will come to the assessing officer. But then the problem is the notice of demand may come later from the assessing officer. Only at that stage you will come. Because notice of demand will not be sent by the commissioner appeal or the commissioner. It will always be sent by the AO. Right? Now coming to 271 AAD, which is a completely new provision. 271 AAD says, without prejudice to any provisions of any other provisions of the Act, if during any proceeding under this Act, it is found that in the books of account maintained by any person, there is a false entry or an omission of an entry which is relevant for the computation of total income of such person to evade tax liability, to evade tax liability, the AO may direct that such person shall pay by way of penalty an amount equal to the aggregate amount of such false or omitted entry. Please note, AAD is not linked to the income, the quantum of AAD penalty. It is linked to the amount of income. It is not linked to the amount of income that is determined, but to the extent of the false entry or the entry which is omitted. So it talks of two situations, a false entry and an entry that is omitted. But then the primary requisite is it must be found in the books of account. It is found that in the books of account maintained, there is a false entry. So books of account is relevant. If there is no books, no 271 AAD. Or an omission of an entry which is relevant for the computation of total income of such person to evade tax liability. Now there is a comma before the words to evade tax liability. So in my understanding, the word to evade tax liability should be linked to both a false entry and to an omission of an entry which is relevant for the computation of total income. Not merely to the omission of entry, it is relevant to the computation of total income. It is also to be tagged on to a false entry, because if a false entry is there which does not result in evasion of tax liability, in my opinion, 271 AAD is not applicable. The AO, it says, may direct that such person shall pay by way of penalty a sum equal to the aggregate amount of such false or omitted entry. Right? Now again here, if you see AAD, just like the provisions of AAB and AAC, only talk about a circumstance where the AO can initiate the penalty. So the CIT appeal, etc. cannot do it. I can understand this probably in the course of AAD proceedings, because he may detect the false entry. But what if the commissioner detects the false entry in 263 proceedings and he enhances the income? Can we say that no penalty is leviable? That will definitely be an arguable point. Also remember that AAD 1 clearly says during any proceeding under this Act. So there should be a proceeding for AAD 1 to apply. Why I am emphasizing on this, I will come back. So AAD is on the person who makes the false entry or omits to make an entry which has the effect of evading tax liability. Subsection 2, it says without prejudice without prejudice to the provisions of subsection 1, the assessing officer may direct any other person who causes the person referred to in subsection 1 in any manner to make a false entry or omits or causes to omit any entry referred to in that subsection shall pay by way of penalty a sum equal to the aggregate amount of the false entry or omitted entry. I can understand subsection 2 insofar as an false entry is concerned. I can understand it insofar as a false entry is concerned. Now, to extend it to a omitted entry, see, how can I induce you to omit an entry? Now, before we proceed further, there are two aspects. Why is 271 AAD inserted? If you see the memorandum explaining the finance bill, the finance minister, after the speech, and if you look at the memorandum explaining the bill behind, even in the speech, they very clearly said that fraudulent input tax credits are being taken. Fraudulent input tax credits are being taken under the GST. In order to prevent that, we want a new section called AA, 271 AA. So, first of all, I for one would think that if you want to administer a law, administer it through the same law. If you want to administer GST through income tax, it is going to become cumbersome. But my view is not the final view, that's just my thought. That's just my thought. Now, supposing I am giving you a false bill by which you are taking an input tax credit, then you are hit by 270 AAD1 because you have made the false entry. I am hit by 271 AAD2 because I induced you. I caused you to make the false entry by giving the false invoice. Right? Now, supposing I was introduced to you by 1A, then will A also be liable for subsection 2? Under subsection 2, my answer would be no. AAD is not applicable for the person who is acting as some kind of an intermediary. For the person who is acting as some kind of an intermediary. Right? That cannot happen. So, we will have to understand AAD1, let's to put it very, very crudely, AAD1 as the person who enters the false bill and the person who gave the false bill, the bogus bill, in subsection 2. So, where is the question of inducing somebody? Now, there are other questions in the context of AAD. First, please note that AAD1 very clearly talks of a person who makes the false entry. And supposing he goes in appeal and his penalty is deleted, will it follow that AAD2 person will also have to have his penalty deleted? The answer has to be obviously yes. If you did not make a false entry, how can I have induced you to make the false entry? Answer has to be definitely yes. A. B. AAD1 talks of a proceeding which is pending. AAD2 does not talk of the proceeding pending. So, can it be done even when there is no pendency of proceedings? The answer has to be yes, because subsection 2 does not contemplate the pendency of proceedings. So, if in your assessment it is found that you have made a false bill entry and I have given you the false bill, for me there is no need for a proceeding for initiation of 271 AAD2. For you, in the course of proceedings, it has to be initiated because it has to be found in the books. Now, what if, what if an AAD2 person does not maintain books at all because he is not required to maintain? He is giving bogus invoices, but he is not required to maintain books. Let's say he is returning income under 44 AD. What happens in such cases? Please note that AAD2 does not talk about my books of account at all. AAD1 person only, it should be found in the books of account. The omission to make the entry or the false entry should be found in the books. Next question. Supposing I am just a bogus entry operator and I provide bills to various people. A, B, C, D, E, F I have provided. Now A's assessment is taken. They find that I have given a bogus bill. They find that I have given a bogus bill. Right? Now, will the AAD 2%, that is me, the example that I took, be liable for penalty only for the false bill to A or all the persons A to F? In my view, it should be only in respect to the false bill given to A and not to the other persons, because it specifically says in a manner to make false entry or omits or causes to make a false entry. So that's how it has to be looked at. Now, AAD also defines in its explanation what is a false entry. It says, explanation, for the purpose of this section, false entry includes use or intention to use. Please note carefully, use or intention to use. Forged or falsified documents such as false invoice or in general a false piece of documentary evidence. It need not be only a false invoice, it can be a false piece of documentary evidence. For example, it can be an evidence in the form of an agreement to sale, whatever you could contemplate. Or invoice in respect of supply or receipt of goods or services, or both, issued by a person or any other person without actual supply of receipt of goods or services, or both. Okay. Without receipt of the same. So it can also be contemplated. Next, invoice in respect of supply of or receipt of goods or services, or both, from a person who does not exist. Oh, this is something which is little unfathomable, because AAD 1 is a person making the false entry. AAD 2 is on the person giving the false entry. So that they are contemplating a situation where you create your bogus bill yourself without a second person involved in it. That is, there is no AAD 2% at all. And that can also be subject matter of penalty under AAD. Now, one other very, very crucial aspect is the language used in the explanation. It says, for the purpose of this section, false entry includes use or intention to use. Now, we are talking of a penalty. Supposing I have got a bogus bill, but I have not entered it in my books of account. In the course of a survey, you come and find the bogus bill. Can you say I had an intention to use it and therefore penalty should be leviable? I would think no. Unfortunately, the language here says intention to use. Well, this intention is a very difficult term. I probably will deal with one or two more aspects, because it talks about a false entry. Supposing there is a journal entry reversing a wrong entry, can that be said that the wrong entry originally made is a false entry? No. Because the law says to evade tax, I have already corrected it through a journal voucher. So that cannot be subject matter of 271 AAD in my understanding. I'll deal with only one last aspect which I promised to. Now go back to the provisions of 270 capital A 11. 270 capital A 11. It says no addition or disallowance of an amount shall form the basis of imposition of penalty if such addition or disallowance has formed the basis of imposition of penalty in a case of a person for the same or any other assessment year. But then, supposing there is a false entry, that may have a result on the income also, and that is a false entry. So can both the penalties be levied? AAD also, 270A also. This is similar to your 271 AA issue in the context of international transactions. Now, these, friends, are some of the issues. So I'm sorry, maybe I'll take one more issue which occurred to my mind as I'm discussing. I'll just take this one issue where, if you see, the Commissioner of Income Tax has the power to waive the penalty in certain cases. And that is provided for in 273A, the Commissioner or Principal Commissioner. Now, there I find a very peculiar language, something that I noticed just now, which is applicable to 271(1)(c) and 270A also. Basically, if penalty is levied, that can be granted waiver by the Commissioner once in your lifetime. That's how the law provides. Now, the explanation to 273A says, for the purpose of this subsection, a person shall be deemed to have made full and true disclosure of his income or the particulars relating thereto in any case, where the excess of income assessed over the income returned is of such nature not to attract section 270A or 271(1)(c). If it does not attract 270A or 271(1)(c), friends, why should that be levied at all? It should not be levied. Then if it is levied, I would rather go in appeal. Why should I come for a waiver? Because it's a once in a lifetime opportunity. So it looks like they have somewhere, lost track of 273A, and 273A should allow me to claim immunity once, even where it is otherwise possible to levy penalty under 270A, etc. So friends, I'll stop here, but I have a few questions already. I will take them before I stop. Whether decision in the case of Reliance Petrochemicals is still good for the purpose of underreporting, misreporting if the claim is backed by an interpretation of law and disclosure is made. Sir, rightly or wrongly, the language prima facie used in 270A2, which talks of underreporting, or 270A3, which talks of what is the total income which has been underreported, does not seem to give scope for bringing in the decision of Reliance Petro. But as I said, 270A6 is illustrative, and if you have relied on a particular interpretation of law, I would think that penalty under 270A is not at all exigible, because basically underreporting or misreporting is not merely an arithmetic calculation. It is not merely an arithmetic calculation. And therefore, in my view, there cannot be a case to say that even where it is an interpretation backed by certain legal precedents, etc., penalty will be exigible. For example, let me say I am talking from Chennai. Let's say the Madras High Court has interpreted to say that a particular deduction is allowed. I make the claim based on the Madras High Court. Subsequently, let us say the Supreme Court reverses the Madras High Court. Can penalty be levied saying that there is a variance in the income? My understanding is no. So, in my understanding, though expressly not provided for, the decision in Reliance Petro will still hold good if there is a particular interpretation of law which is there on the basis of which you have taken a view, and if the claim is backed by such interpretation and all disclosures. Now, the second question is, from when is AAD applicable? AAD is introduced with effect from 1/4/2020, that is in respect of transactions from 1/4/2020 or in respect of or from assessment year 21-22. Assessment year 21-22 onwards, it will apply. What about earlier proceedings which have been completed after 1/4/20? In my view, it will not apply, because the basic tenet of crime is that what is not a crime when it is committed cannot become a crime by a subsequent act of Parliament. When I committed it, I was not liable for 271 AAD. Merely because you do the assessment later, AAD cannot apply. AAD will apply only for and from assessment year 21-22. This is my understanding. Friends, these are the questions I had. For the time being, I'll have the mic handed over to the organizers. If there are any questions, please. But in the meantime, I must thank all of you for a patient hearing.
Sir, I have a question. Can I ask?
Please, sir.
Sir, this 270AA immunity, we have two conditions to be satisfied. That is, taxes needs to be paid and appeal cannot be filed.
Yes,
right?
sir.
So, when the order is passed, without considering whether it is, see, you know how the Babus are behaving when they do the assessments. Okay. Simply they take whatever we submissions, in maximum cases they don't consider because we go to appeal. Now this provision of appeal is barred when we want to go for immunity. Is it in line with the canons of taxation what we have?
So I think the canons of taxation are evolving very much. And therefore, I would think that the present, the way the laws are being made, etc., they are virtually actually 270 AA is some kind of an arm twist, where you say if you want immunity, you pay the entire
To
tax.
pay the entire tax and come.
Whether that addition is warranted or not, let us.
That is what, sir.
So to my mind, that is a little dangerous, but all the same, that's how the law provides for. But as you rightly put it, sir, it seems to be some kind of an arm twisting tactic rather than an immunity mechanism. They are trying to hasten the collection of taxes by saying, okay, you pay. It's something like a perennial VSV. Some kind of a perennial VSV.
Yes, sir.
Where, they are trying to grant immunity.
So this is one thing, sir. And secondly, when there are two alternative provisions are available in the Act, there are decided case laws, and the Act is very clear that which is beneficial to the SSC needs to be adopted. But when we see this 270 capital A and other provision, when there is a two opinion which is beneficial to the department, they will be taking.
Sir, I think this is an aspect on which I dealt with. In my understanding, if there are two views possible, and if you have taken one possible view, then penalty should not be exigible under 270 capital A, because in my view, 270 capital A6 is not exhaustive but illustrative.
Yes.
Right? So the decisions that are earlier been rendered by the Supreme Court and various high courts, that if a possible view has been taken, then penalty is not leviable, will still hold good. I have one more question. What is the relevance of the word may in 270A1 of the Act? As it seems that section is mechanical, and so to fall out of it, you have to go back to 270A6, and hence the word may in section 270A1 is whether giving any type of discretion to officer to not levy penalty, even though conditions in A2 and 3 are satisfied. Friends, I'll repeat. In my understanding, A6 is not exhaustive but illustrative. That is the reason why A1 is using the word may. I can even give you one other reason why I am coming to this conclusion. One is the use of the word namely in A6, because namely is normally used when it is illustrative. Two, I explained one decision of Supreme Court in the context of what is the meaning of the term landlord. And three, if you see subsections 4 and 5 of 270A, they are contemplating an addition made under 68 or whatever the provision, an intangible addition, and contemplating no levy of penalty, and contemplating further that if you seek to take source credit, I will levy penalty in that year in which you take source credit. So they are contemplating the non-levy of penalty in a year where there is a variance of income. So that is also not covered by subsection 6. So I would think that subsection 6 is purely illustrative, and that is the reason why subsection 1 uses the word may.
Probably, sir, the intention is to uphold mens rea. A guilty mind has to be established, or is it been watering down over the years?
See, so far as mens rea is concerned, I think there has been substantial water that has flown as to whether mens rea has to be, even if you take penalty for prosecution, for example, the prosecution provision says mens rea is presumed. Now here, there is no presumption of mens rea or otherwise, but then if you give an explanation that is bona fide and provide all material facts, there is no penalty. So that is effective in saying that a mens rea is necessary, but then the burden is on you, not on the revenue. The burden is on you to show that there is no mens rea. The burden is not on the revenue. That is all I will say. Mens rea is still required, but you will have to discharge the burden, not the revenue authorities.
Any other questions, participants? You can.
Sir, I am in the meantime sharing my email ID. I am sharing my email ID. If anybody wants to email me with any queries at later points in time, please feel free.
Sure. Thank you, sir.
But it's not to the, this is without prejudice to asking questions now.
No, sir. No, sir. Nilesh bhai, kindly take care.
Yeah, sure. So one request, sir, if you could share the citation of that Bombay rents and hotel case. That would be useful.
I will one.
Get later as well. It's fine.
It is in 1993, SCC 1712. 1993, SCC 1712. I have sent it to.
Thank you. Thank you very much. So, friends, I presume there are no more questions. If at all, sir has already shared his email ID and you are free to send across the questions to him. So, thank you.
To conclude, Mr. Nilesh, I have to first of all thank not only the organization, but Mr. Ramamurthy in particular for forcing me to come and speak. In fact, his invitation was so enticing that I could not refuse. Though he would say I was very kind, I was not being. He was being so extra kind in contacting me and following up and ensuring I gave the dates. But he was humble in saying I was being kind. That was not the fact. But then the reason why I am thanking the organizers and the organization and Ramamurthy is that, it gave me an occasion to relook. In fact, there are so many new points that I have come across in the last 2-3 days that I have done a little homework on. And these came to me or came to my knowledge or to light to me because of having to speak today. So to that extent, I am grateful to the organizers for giving me this.
Thank you, sir. Thank you.
And all of you for a very patient hearing.
You are our guru, sir. You are our guru. So it is, we are fortunate to hear you. That is what we take, sir.
See, the greatest archer was Arjuna, sir, not Drona.
In fact, you had one session in that recently concluded referential for appellate tribunal procedures also.
Yes.
Before the Rakesh Gupta sir's session. So we were fortunate to hear you in that also.
Thank you.
No, then I proposed, so why don't we disturb Banusekar sir to address us? So thank you very much, sir. Thank you very much, sir. Yes, sir. Nilesh bhai, kindly propose.
So, participants, you'll agree it was a fantastic presentation by Mr. T. Banusekar, Chartered Accountant. I liked the phrase variance penalty. It reminds me of that additional tax under 143(1)(a), which used to be levied automatically once there was an adjustment in the intimation. Something similar is happening now, and we are now better equipped than we were before hearing Mr. Banusekar. So thank you a lot. Thanks a lot, Mr. Banusekar, for introducing the topic to us and pointing out the nuances which are involved in all the penalties which he has covered today. So thank you once again, sir. And before we leave, I have a pleasant task of sharing a certificate of appreciation, sir. So I'll just take a minute. Yes. On behalf of the Hyderabad Study Group and the Chamber of Tax Consultants and all the participants, we present to you this certificate of appreciation for sparing your time and efforts for us, sir. So I'll be mailing this to you. And thank you for in the present conditions, this is the max we could do for you, sir.
Sir.
Thank you very much, sir. Banusekar sir, thank you very much.
CTC. I'm part of the CTC. I don't deserve more than this.
Thank
you very much for this, sir.
And that because the first time I heard you was as a part of a group member in one of the RRCs of CTC or BCS, I don't recall. And that is the time, about 15, 20 years back, I had heard you for the first time.
Okay.
Since then, we had wanted you to invite you. So thank you for joining us today.
Thank you. Thank you.
Thank you very much, sir. Thank you, sir. Thank you.
And before I forget, all the participants who are from outstation, we request you to become members of HSG. We will be conducting online programs like these every week. And one forthcoming program, which we have already confirmed, is on 5th of September, Saturday, first Saturday of the month. We have a presentation by Sekiyar on the auditing standards. So that would be an interesting topic. We'll share the details on the WhatsApp group. So those who are not there on our WhatsApp group, please do become members of HSG, and that you can do by going to the CTC Online website, ctconline.org. You'll have the details there. Thank you very much and good night, everyone.
Thank you very much, sir. Thank you.